So that's what I think is happening, guys. We've got a new Havenstein taking charge of the Fed very soon, and the market sees it. And unfortunately, 99.9% of the public will not see it coming, and they'll have no idea of what's happening. And the same thing happened, unfortunately, back in 1923. Monday, January 26, 2026, Maneco 64, home of alternative economics and contrarian views. While gold and silver continue to surge, or more appropriately, the dollar and all other fiat currencies continue to sink. As I said yesterday in my live stream, I think the die is cast for very serious monetary event, an event that hasn't happened for the world's reserve currency ever, really. It happened in Germany in 1923, but the Reichsmark was not the major reserve currency, so people could still protect themselves with the dollar and the pound sterling. But now the whole world is mostly in dollars. Of course, that's changing. Gold is becoming more and more important. The central banks, the big money and family offices, sovereign wealth funds, they see that coming, and they're rushing away from fiat currency. And we know, of course, that fiat currency always reverts to its intrinsic value, which is zero. And that's what Voltaire once said. He was 100% correct. And it's not going to be any different from the United States and its fiat dollar. But I found some interesting points and some interesting things said by Rick Rieder, who's the CIO of BlackRock, and who's tipped to become the next Fed chairman. And it's really, well, it is kind of worrying, but not for me, and it shouldn't be for you, because we saw this coming, this hyperinflation, this currency collapse. And why did we see it coming? Well, because once you go down the road of inflating the currency, of printing funny money, of deficit spending, it's very hard to get out of that road. And unfortunately, experts, the financial press, universities, the economic class, people like Rick Rieder and others, they don't really understand what inflation is. They only look at CPI. They don't look at the money supply. They don't look at the Austrian school. So I think they're oblivious to it. And I found an interview that Rick Rieder did with the Goldman Sachs YouTube channel. Someone from Goldman Sachs interviewed him, Rick Rieder, CIO of Global Fixed Income at BlackRock, and Jan Hatzius, chief economist at Goldman Sachs. So the guy from Goldman Sachs interviewed Rick Rieder from BlackRock and the Goldman Sachs economist. And this was in November 2021, and we're going to dissect parts of this video. And Rick Rieder, I would say, is the new Rudy Havenstein. Yes, not that Rudy, of course. Rudy or Rudolf von Havenstein, or Rudolf Havenstein. He was the head of the Reichsbank during World War I and in the run-up to the hyperinflation. Rudolf Havenstein. He was trained as a lawyer, but he was the head of the Reichsbank. And he was the one who led the Reichsbank into hyperinflation, into the collapse of it. And yeah, so we're going to look at that. But I just, before we start and delve into this topic, just wanted to give you an update on Chancery Royalty. Many of you know that I was appointed to the board of directors of this up-and-coming gold and silver royalty company. It's still a private company. We'll probably be doing an IPO before the second half of this year. And yes, they're definitely going to close the pre-IPO equity raise this coming Friday. So if you're interested in finding out more about this opportunity and this company, there's a link below in the description. You can go there and read about it, choose to get some information. But Jeremy Gray, the CEO, he contacted me overnight. And yes, we are planning to go and visit Pilar Gold, which was one of our biggest royalties in Brazil, in the state of Goiás. And many of you know that I'm originally from Brazil. So we will be traveling there after our trip to Ethiopia in about 3 weeks. We will be traveling to Brazil. I haven't been back home to Brazil in about 11 years. And yeah, really looking forward to it. And hopefully do a podcast or a video from Ethiopia and Brazil. Unfortunately, Rudy won't be able to come with us. But anyway, just wanted to let you know that. So back to Rick Rieder, Rudolf Havenstein, back in the day. And I'm going to refer to this book here, When Money Dies. I've read it a few times, but you kind of forget where the passages are. And I knew there was a passage about how Rudolf Havenstein and the whole German financial leadership thought that you needed to print more and more Reichsmarks to lower inflation, right? And it's crazy to think that, but we're going to go through the passage here where they say that, and I'm going to go also over what Rick Rieder thinks, and I think he thinks along the same lines as Rudy or Rudolf Havenstein, actually. So let's go to page 170. It's chapter 11. Chapter 11 is Havenstein. No situation, however, was so bad that summer that Dr. Havenstein could not make it worse. Nor was anyone in the government who ostensibly knew less about these things than he disposed to remonstrate with him, the guardian and leader of orthodox German financial opinion. He held firmly to his view that money supply was unconnected with either price levels or exchange rates, saw his duty as having to supply to the limit of his ability the medium of exchange for which, because of the mark's ever-tumbling purchasing power, his countrymen were crying out for, and was spurred to renewed activity by the latest enormous price rises with which they were beset. The sheer logistics, not to speak of the incredible expense of printing and distributing time and again the amounts with which he was dealing, appeared to be his greatest worry. And although notes of adequate denomination were only transiently available these days, no one in the banking world or in the Reichstag ever suggested that someone else could have better mastered the difficulties of providing them. The full enormity of Havenstein's policies was duly revealed in the speech he made, published immediately afterwards, to a Council of State on August 17th. The Reichsbank, he said, with evident pride and satisfaction, today issues 20,000 milliard marks of new money daily, of which 5,000 milliards are in large denominations. In the next week, the bank will have increased this to 46,000 milliards daily, of which 18,000 milliards will be in large denominations. The total issue at present amounts to 63,000 milliards. In a few days, we shall therefore be able to issue in one day 2/3 of the total circulation. How he would bring all this paper in circulation was the least of the questions raised. Havenstein had been completely unconscious of the disastrous effect his intended action, and even more its proclamation must have upon the mark's value, not to speak of the whole financial, trade, and industrial structure of the country. So there you go. They thought that they needed to increase the money supply to alleviate inflation. And I've looked into Rick Rieder, and I did a little Google search. Rick Rieder, 3% rate, Bloomberg, and this popped up. It says AI overview, BlackRock Chief Investment Officer of Global Fixed Income, Rick Rieder, has advocated for the Federal Reserve to lower interest rates to approximately 3%. Well, it's at 3.75 now. CPI, or inflation's running around 3%. So, and it's probably a lot higher because they lie about it, right? They don't really, they change the methodology every few years. They did that about 4 years ago. Citing a significantly softening labor market. So you see, he thinks it's the labor market that creates inflation. He doesn't realize that inflation is the increase of money and credit, right? Right? I should call him Rick Havenstein Rieder. Well, Rieder is German name, so it fits, right? Rick Havenstein Rieder. It also says here, he said there's a need to support the housing sector. In late 2025 and early 26, he argued this level is appropriate for the current economic environment. And that's despite the fact that the stock market at all-time highs, gold and silver prices are going through the roof. This guy wants to slash interest rates. So slashing interest rates is akin to printing money because it's going to create more and more credit, and banks and shadow banking institutions, they're going to lend more and more to people, and there's going to be more and more spending. So I said I found this interview from November 2021. It's November 22nd, 2021 to be exact. And I had a look at what was going on back then in terms of interest rates. Or in terms of bond yields. And if you look at the Treasury 10-year yield around that period, towards the end of November, it was below 1.5%, right? Right now it's 4.2. And at the time, all the talk was about transitory, that the inflation was going to be transitory. The core PCE was still around 3.6, even though the 10-year yield was like 1.2. So the market and people like Rick Rieder and the chief economist of Goldman Sachs, they thought that inflation, or this CPI that they call inflation, would come down. They're very complacent. Yeah, so they were not worried, and also the CPI was at 5, core PCE was at like 3.6, and by 2022, that had gone up almost to 10%, the CPI, right? So they were completely wrong. They were the transitory guys.
Current data don't necessarily provide a great deal of guidance for where things are going to be a year from now. And I think there are good reasons to think that will come down very, very substantially on these inflation numbers.
I mean, I'd say a couple of things. I mean, I think the general trend, I mean, I totally agree with Jan. I mean, where we model it up, we think core PC peaks around 3.5, maybe a little over that over the next few months, and then starts to revert back down.
And I took some notes here of what Rick Rieder said, and the other guy. They basically said that they're not concerned this was temporary, right? Because of COVID, people had a lot of money to spend, but things would normalize. But Rick Rieder is one of the guys who used to think that demographics, i.e. an aging population, the baby boomers saving, that would keep long-term rates down. And he also said that all the money and credit would be used for infrastructure, and it would accelerate the economy and keep things under control, and that he wasn't worried about the huge debt pile that the U.S. had taken since 2020, right? He thought that the U.S. could cope with that, and that rates would remain low, real rates. And at the time, of course, the 10-year yield was below 1.5%, and now we're at 4.2. And he said that we were at a unique point in time and that we could do it. He thought, yes, if we were less developed or a third world country, we couldn't carry as much debt as we had. That's what he said.
I actually think that real rates will stay down for a longer period of time. So anyway, I think I think that is significant, and that because of that demographic, because of the growth of pensions and life insurance companies and demographic evolution, I do think that you can absorb, the system can handle a larger debt stack than we've ever seen before, as long as we're thoughtful about managing inflation, thoughtful about keeping those rates down. I think it's a unique point in time, and I'm not. If you take, I did this analysis. I looked at functionally the U.S. government relative to how I spent my whole career looking at companies, and I looked at if you look at interest coverage, or you look at debt to EBITDA, or you take your asset coverage, and you look at the U.S. and say, and you put up all those metrics, and debt to GDP. I think when people look at sovereigns, they say debt to GDP. If you approach 100%, that's really scary. I'm not. If you're an emerging market country, totally get that. If you're the reserve currency in the world, I'm not sure I totally get that. And if you look at your interest coverage, your asset coverage, and taxation, et cetera, then I think you can actually run it. Like I said, if you thought rates would spike 200 basis points higher, that becomes a debilitating dynamic. And then you change that interest coverage dynamic. But I actually think the system is in a unique point in time, and I think there's real velocity to, if you're using that fiscal stimulus in infrastructure and that areas that have permanent, durable velocity to it, then I actually think your tax, what happens in terms of tax proceeds, and because of that velocity and because of that growth, that spending is and running that size debt load is not that scary.
So I had a look at the money supply, which is something they didn't talk about in this video, and the money supply, M2, had gone up by 38.2% since just before COVID in January 2020 to November when they were speaking. So it went from $15.1 trillion to around 21.3. So no mention of that would lead to a lot higher prices because they don't know what inflation is. So I think the markets know this. Foreigners know this. And this idea that Rick Rieder is neutral and he's not biased, that he's not going to do Donald Trump's bidding at the Fed, I think is totally erroneous. I think what Donald Trump did and his advisors, they picked someone that wasn't particularly pro-Trump, but was a bit of a Rudolph Havenstein. So, and I think that's why unfortunately, we're going to go into a currency event. Is it going to be as quick as it was in Germany? Maybe not as quick, because I've showed you those two charts where I compare hyperinflation in Weimar Germany and the current chart of gold, monthly chart of gold going back to the late 90s. And they're very similar, they're almost identical, but the chart now, the fractal, is over a longer period of time. It's the same chart, but longer period of time. So in Germany, things got really bad in the summer of 1922. That's when gold took off and the Reichsmark continued to, started sinking. In Germany, by the end of 2023, there was no more Reichsmark. They had to come out with a Rentenmark, and guess what? The Rentenmark was backed by gold, and they couldn't print it willy-nilly anymore. So it took about 18 months, and I guess we are just over 12 months along the way. And that fractal, of course, is longer, so we could have another 18 months before things get really crazy. So I think there's still time to get you out of Dodge. If you have large balances of fiat currency, if you're fortunate enough to have a lot of wealth, and this is not financial advice, I would be rushing to put it into real assets, i.e. physical gold and silver miners. I think there's still a bit of time. But, as I speak here, it's 10 past 8 a.m. London time. We've got gold at 5,090. Yeah, it's up over $100. The high's been 5,111. Again, that's not gold going up. It's the dollar. It's all the other fiat currencies sinking, and it's not good. We've got silver touched almost 110. It's now at 108.50. So that's what I think is happening, guys. We've got a new Havenstein taking charge of the Fed very soon, and the market sees it. And unfortunately, 99.9% of the public will not see it coming, and they'll have no idea of what's happening. And the same thing happened, unfortunately, back in 1923. So, as my friend Ari van Gameren of the Timeless Investor channel says, human nature never changes, and we keep making the same mistakes. And that's why it's so important to learn about history, and because it helps us forecast what's coming, and it's not good what's coming, not good for anyone. Yes, we might be a little bit protected from this, but one thing I would say as I end here is keep an even keel. Don't get too despondent when gold and silver might correct. Don't get too excited and cocky on days like today. Yeah. Don't change the way you are, and try to help as many people as possible, especially those close to you and your neighbors. That's all I will say to that. So anyway, with that, I'm going to wish you all a very good day and a very good start to the week. Take care. Bye.